Welcome to Essential Biz Marketing. Today, we'll explore Practice 3, Evaluating Hungary versus Poland for CJ Chiljedong's Bibigo facility. Let's begin by understanding what the Economic Freedom Index is. It's a key indicator that assesses each country's economic environment based on 4 factors: rule of law, government size, regulatory efficiency, and market openness. Now take a closer look at how the Economic Freedom Index is measured. Each factor contains specific components, and each component is rated from 0 to 100. A higher score indicates greater economic freedom for businesses and individuals. Let's explore the first component of the Economic Freedom Index, rule of law. This includes property rights, judicial effectiveness, and government integrity. Together, they safeguard businesses and individuals by ensuring a stable legal environment. Now consider the second component, government size. It examines how taxes and government spending influence the economy. Higher taxes and excessive spending reduce economic freedom, while low taxes and lean government increase it. Next is regulatory efficiency. It measures how easy it is to start and operate a business, labor market flexibility, and stability of prices. Less interference from government means a more favorable business environment. Finally, we have market openness. This assesses the level of trade freedom, investment regulations, and financial freedom. Lower trade barriers and fewer restrictions on investment contribute to higher economic freedom. Let's now examine how the Economic Freedom Index scores are calculated. Data comes from the World Bank, IMF, and WTO. Each component is scored from 0 to 100, and an overall average score is created. A higher score on the Economic Freedom Index indicates that businesses can operate more freely. This leads to easier business operations, increased foreign investment, and stronger economic growth. In contrast, when governments impose high taxes and strict regulations, economic freedom declines. This results in slower business growth and reduced international competitiveness. Countries that maintain strong legal systems, minimize regulation, and promote open trade consistently achieve higher Economic Freedom Index scores. This balance creates an attractive environment for businesses and investors alike. Now let's apply what we've learned to a real-world case. CJ Chiljedong selected Hungary for its Bibigo production facility. Although not officially confirmed, it is highly likely that Poland was also considered as an alternative based on regional proximity and market conditions. To evaluate both countries, CJ Chiljedong considered key factors: rule of law, government size, regulatory efficiency, and market openness. These factors help businesses understand risks and advantages in different locations. Each factor influences important elements like property rights, taxation, labor market flexibility, and trade conditions. This structured comparison helped CJ Chiljedong understand why Hungary ultimately became the preferred choice. Let's start with the rule of law comparison. In property rights, Poland scored 72.3, offering stronger protection, while Hungary scored 69.2. This means companies in Poland are more likely to have their property and intellectual rights secured. Judicial effectiveness also favored Poland, with a score of 58.4 compared to Hungary's 42.2. This indicates that legal disputes in Poland are generally resolved faster and more fairly. However, Hungary outperformed Poland in government integrity, scoring 62.7 versus 52.3. This suggests that businesses in Hungary may face fewer corruption-related challenges in day-to-day operations. Now, let's examine government size, starting with tax burden. Hungary scored 85.3, offering lower taxes, while Poland scored 73.8. This allows companies in Hungary to retain more after-tax profits. Next, government spending shows a contrast. Hungary's score of 28.5 reflects limited spending and more private sector freedom. Poland's higher score of 39.7 indicates greater public sector involvement. Finally, fiscal health clearly favors Poland. Poland scored 75.9, indicating a stable macroeconomic environment. Hungary's score was only 17.6, raising concerns about fiscal stability. Let's move on to regulatory efficiency, starting with business freedom. Poland scored slightly higher at 77.8 compared to Hungary's 76.1. This suggests businesses may find it just a bit easier to operate in Poland. When it comes to labor freedom, Hungary holds an advantage. Hungary scored 60.3, while Poland scored 56.8. This greater flexibility allows companies in Hungary to adapt their workforce more easily. In monetary freedom, Poland again had a slight edge. Poland scored 68.5 compared to Hungary's 65.1. This means Poland offers a more predictable pricing environment with greater price stability. Now let's compare market openness, beginning with trade freedom. Both Hungary and Poland scored 79.6, indicating low trade barriers and efficient access to international markets. In terms of investment freedom, both countries scored 80.0. This means companies can transfer capital with ease, supporting business expansion in either country. Finally, both countries also matched in financial freedom, each scoring 70.0. Businesses in both Hungary and Poland have relatively open access to financing, despite some government oversight. Let's summarize the overall comparison between Poland and Hungary. Poland leads in rule of law, regulatory efficiency, and fiscal health, offering a stable environment. Hungary stands out with lower taxes and greater labor flexibility, appealing to cost-conscious companies. Let's now look at the key decision factors. Poland offered long-term stability with strong legal protections and macroeconomic health. Hungary provided short-term cost savings with lower taxes and labor flexibility, which ultimately influenced the decision. Hungary's low 9% corporate tax rate and lower labor costs provided a clear cost advantage. These financial incentives played a major role in CJ Chiljedang's decision. Another factor was Hungary's flexible labor market. Companies can more easily adjust staffing levels due to fewer restrictions in employment laws. This flexibility reduces risks during economic changes. Hungary's strategic location also mattered. Its proximity to Germany and Austria reduces transportation costs and supports easy access to key European markets. Simplified and business-friendly policies further enhanced Hungary's attractiveness. Easier regulations make setting up and operating a business faster and less complicated. In summary, CJ Chiljedang likely prioritized short-term cost savings and strong government incentives. These combined factors led to the decision to choose Hungary over Poland. This concludes today's session. We look forward to exploring more topics together in future videos.